Hi guys, welcome to my channel Easy ACC and Accounting Tips. Let's have a brief review of the main types of financial statements. We have profit and loss, balance sheet, changes in equity, and accompanying reports, notes, auditors and directors reports. The profit and loss statement is the current period's results obtained by subtracting this period's expenses from this period's income to obtain either its profit or loss, thus the name of the statement. The balance sheet, on the other hand, is a historical representation of the business transactions performed to date, and it includes the results of the period, thus this period's profit and loss as well. The balance sheet and profit and loss statement are the key fundamental statements for any business. The balance sheet, as its name states, is the balancing figure of all the business assets to its capital and liability using the double entry principle. The double entry principle assumes that the business is like a box in which all the company's assets are popping, and in the input of these items there is a resultant double entry record, both in the debit and credit side of the accounting records. Note that assets are items controlled by an entity, aiding in the smooth running of its operation, from which economic benefits are expected. It is crucial that this recording results in a balancing figure between the debit and credit sides, usually summarized in a trial balance. The main sources of information for these records are obtained from every invoices, receipts, checks, bank statements, and any other paperwork directly or indirectly related to the business, be it donations, contributions, or subscriptions. Let's get started with the recording. It is performed using the T accounts illustrated above, where increases in assets, say the purchase of machines, stocks, buildings, are debited on a T account, and a resultant credit entry is made either on a cash account to show the decrease in another asset, or a credit is made on the capital or liability T account to show an increase in capital or liability. Same goes with increases in capital, say the owner pops in cash, there will be a credit entry in the capital T account and an equal debit entry in the cash T account, or the business bank account if it is a deposit made directly in the bank. Note that the business and the business owner in an accounting viewpoint are regarded as two separate entities, and any money introduced in the business by its owner are termed capital. Likewise, any money or asset taken from the business are regarded as drawings or dividends, depending on the nature of the intake. Finally, increases in liability, which is money owed to third parties to run the business, like loans, overdraft, trade creditors, or others, will result to a credit entry in the individual account, and a debit entry is made either on the cash T account, expenditure T account, depending on the nature of the transaction. In my next session, I will be happy to illustrate each steps taken when recording and how it results to financial statements. For now, I would rather invite you to realize that the double entry principles aid in summarizing the business daily transactions to produce financial statements. Thank you for your attention. I'm expecting your questions and comments for further inquiries and quarrels. Bye.